There certainly is a lot to digest. Let's get into all of it. For that, we want to bring back in Ken Leon. He's the CFRA's Director of Equity Research. And Ken, it's been about a week since we last talked to you. Lots of stuff has happened within your sector, within the financial sector over the last 7 days. So just break down, I guess, how you are looking at the events of the last week.
Well, it's great to be back here. And we certainly have moved from either idiosyncratic or one or two bank failures to a lot of investor uncertainty really about the banking system. And one of the Fed's mandate is financial stability. And we saw that at work, working with the largest banks on funding for First Republic, but also the liquidity that they're doing between the Fed and the large banks, $450 billion. So what does this all mean? Investors usually are nervous. They don't want to be long for the weekend to perhaps another episode. And then we had Credit Suisse, but CFRA, we've done rigorous reviews of US and European banks. There's fewer larger consolidated banks in Europe, and the liquidity position is stronger. The issue and my focus in the US is the third rail of risk, which is really bank supervision. We have roughly 3,600 banks that the Fed regulates. When you go downstream below 200 billion, no less, 10 billion to 100 billion, and there's 99 of those banks, $2.7 trillion. We need more resources, more bank examiners to do the work that the Fed can do. So this is also a people story, and it's going to shift to Congress, and it's going to be in the spotlight in terms of questions as when did this happen? Why did it happen? Is it ring fenced? And what are we doing to make sure it doesn't happen? Or no less a concern about financial stability. Those are the questions.
So, Ken, what could that regulation going forward look like? And will it be focused mostly on the regional bank sector?
Oh, it will be. And it's a really increasing regulation. Again, back in 2018 was the legislation that eased the regulation. So it was only the 8 banks above 250 billion. And we've seen, of course, that laxity has created problems. Since bank failures, we've had 2 of the largest ones, as noted in the past week. But then again, there's lots of other banks where, as Sarah Raskin, former Fed governor, said, this is really Bank Examiner 101. It's looking at deposit mix, it's looking at duration mix, the balance between assets and liabilities, liquidity. All these things took many years for the largest banks to put in place since Dodd-Frank. So when you go downstream to a wide number of banks, it's going to take time, both on the regulated side for the Fed to have staffing, and then on the bank side, because they're going to have to steer some of their investments into compliance and regulation. The large banks, that was many, many hundreds of millions of dollars.
And Ken, when we talk about some of the moves here from regulators over the last week, a lot of that was done to help reassure some of the skeptical investors out there, stop some of that panic. That doesn't, though, seem to be translating when you take a look at some of the action that we're seeing in the market today. So did they go far enough, or is regulation, is that the answer to help shore up some of that concern out there?
100%. You're right. And the market is saying we didn't have enough transparency to these specific bank failures, and whether it's endemic to the regulatory oversight of these smaller banks. And, imagine it, it's not only depositors, but also traditional investors, but hedge funds, long, short, looking as they're a cockroach theory of another bank to fall. Generally, the banks are healthy. The system is healthy. This, as you've chronicled this week, is not the financial crisis of '08, where it was not only the largest banks, but also the capital markets. This is a little bit different game, and it's going to take some time to unpeel everything and put it in the sunlight.
And Ken, has this crisis created a sort of two-tier system when it comes to banks, the big, too big to fail banks, the banks that are backed, to then the smaller regional banks? And going forward, if they do see more regulation, I mean, will it be difficult for them to survive and for their stocks to perform?
Well, they have to survive. So whether you're in Washington and saying that community to small banks play an important role in their local areas, and that is critical. And when you get to the largest banks, obviously they play on a global stage and also have an opportunity here, fortunately or unfortunately, to take increased total assets. So it's not really from a policy standpoint where you want to be. But certainly, whether we look at the Republicans or Democrats, they do want these small banks to be around, and I would agree with that.
All right, Ken Leon, always great to get your perspective. Thanks so much for joining us again. Have a good weekend.